Hello guys and welcome to another TV video. Today taking an in-depth look at the Home Depot Incorporated company and also at Intuit. First we'll start with Home Depot. Sometimes it's called the Home Depot, but it's usually referred to as Home Depot. It's an American multinational home improvement retail corporation that sells tools, construction products, appliances, and services, including fuel and transportation rentals. It is the largest home improvement retailer in the United States. We'll start with the most recent full fiscal year, 2023. First of all, let's look at the business metrics. They have a good return on tangible assets, a very high ROE. This is because their equity is artificially lowered by their high treasury stock, so they do a lot of buybacks. But even excluding the treasury stock, it is still pretty high. The current ratio is a great 1.55, so they have very good short-term equity. Their ROIC is 29%. They trade at a price to earnings of 26 and a free cash flow yield of 5%, which is a average valuation from my point of view in the current market. Next, we'll go to Graham's valuation using the 2025 earnings per share, estimated earnings per share. We get intrinsic value slightly below the current price. Now, moving on to discounted cash flow, you see that they've averaged a 13.8% free cash flow growth, and we'll just put in a 7% free cash flow growth for the 7.5% free cash flow growth for the next 9 years, and a 2% perpetual growth rate with an 8% discount rate, which I usually use, and we get intrinsic value extremely close to the current price. Next, we'll move to the dividend discount model, and we'll just leave it at 6%, so slightly lower than their current uh, estimate. So I used 7.5% growth rate for their DCF, and I use 6% for their uh, dividend, and this gives us a DDM price per share of $477. Now we'll just plug in the DDM, so we'll get okay, and using the average of all three, we get an intrinsic value of $405. But applying a 15% margin of safety, you get an acceptable buy price of $344. So slightly below the current price, but not too far. I think this is a great company. Although they're pretty big, so I'm not sure if they'll grow at a very good pace for that much longer, but still they're a good company that, as we've seen, they have great business metrics. They're trading at an okay free cash flow yield. They have an okay payout ratio, so they do not have any problems with the payout ratio. In fact, their dividend can actually grow at more than 6% per year, so their DDM is probably a bit higher than this. Yeah, it's a great company. It's slightly bigger price than I would like to pay for, but it's not the end of the world in my opinion if you want to buy it. Of course, during the diligence, it is the most important thing after all, because do not forget that due diligence is the key to all investing, especially value investing. Now, the second, we'll move to Intuit, their most recent fiscal year 2024, and let's talk a bit about Intuit. Intuit is an American multinational business software company that specializes in financial software. Intuit's products include the tax preparation application TurboTax. I think if you're from the US, you've heard of it. Also, the small business accounting program QuickBooks, the credit monitoring and personal accounting service Credit Karma, and email marketing platform MailChimp. This is a bit different compared to Home Depot because it's much more overvalued. Of course, they have great metrics, just like um, Home Depot. Of course, they have a much lower ROIC, lower ROE, comparable current ratio. This is a great current ratio, but as we can see, their free cash flow yield is 2.56%, and the price to earnings is 55. So basically, double the valuation of Home Depot. Now, let's see if they do warrant this valuation. Let's plug in their 2025 estimated price earnings per share, sorry, and we get a price of $453, which is well below the current price. discounted cash flow, we've seen that they've had great growth, 18% CAGR over 10 years, which is really good. So we'll just plug in 10% growth for the next 9 years and 2% perpetual growth rate. So this is, we get a $460 DCF price per share. Now using the dividend discount model, so because their payout ratio is 35%, I think we can use the same growth rate as in the DCF because they'll just, the discount rates, so I just put the discount rate at 10.5, and yes, because you can't put the growth rate higher than the discount rate, you have to increase the discount rate. So the growth rate, I'll just put it at 10% because, so I'm going to push the discount rate to 11%. No, 10.7. So the growth rate is 10% because I just put it at the same growth as the discount cash flow. Output. Now, using the averages of all three, we get intrinsic value of $522 below the current price. So this is below the current price. And also applying a 15% margin of safety, you get an settled buy price of $444. So at the current price, they're definitely overvalued by quite a bit, actually. Now, what is very interesting here is that I always talk about the idea of two comparable companies in terms of balance sheet, cash flow statement, valuations, etc. And this is a great um, show of what I'm talking about in the sense that these are two companies from different sectors, but one is twice as much values, so to say, as the first, but it actually has a worse business metrics. Of course, this has higher growth, but the difference in growth between Home Depot and Intuit, to be honest, is not that great. And the business metrics of Home Depot are better, and their valuation is half of Intuit. So Home Depot is a much better comparable buy to Intuit. Intuit is maybe a play, but I don't think there is much to see here since I don't think their growth rate really warrants such a high valuation. I may be wrong, but I think Home Depot is a much better play of the two. You must do your own due diligence, you must do your own valuations, but I don't see the play here. Um, I don't see how you can choose Intuit over Home Depot. But of course, this is why you invest your own money. I'm not here to tell you what to do. I'm not a licensed financial advisor, so please do as you want. Yeah. So I think Home Depot is the better buy. If you want or don't want to buy Home Depot, then you can or cannot. But Intuit, to be honest, is overvalued. This has been it for today. Uh, let's not forget our affiliate. Affiliate is Ticker Data. I've used it today to show you Home Depot and Intuit. Ticker Data is this great tool that gives you these templates. So they have much more templates than this one. And they also, so you see this API where you just plug in the ticker symbol, for example, McDonald's, and you get all of the data here. This is ticker data. It's a great tool. So I think you'll love it. I just suggest that you try to use it. So yeah, this this has been it for today. Also, do not forget to check out my investing blog from the link in the description below. And I hope to see you in the next video. Bye.